Rising interest rates? No. Let's call them normalizing interest rates. Ways buyers and sellers are going to adapt to the normalizing interest rates. We have seen the interest rates go from just 2% in just October last year, which is 2021, to almost 5% now in March or May 2022. In just a span of 6-7 months, we have seen the interest rates go up 250 times. Hi, I'm Amol Heda, helping you design your home ownership and author of Thriving Through Ownership. So, I helped some of my clients buy their properties last October around the 2% from 2 for a 30-year fixed, not a 5-year arm, a 30-year fixed. Now just imagine that you have the money and you are going to lend it to somebody. Would you even want to part with your money for just 2% for 30 long years? And that too, that person returns all that money each month in 360 installments? If you don't think you want to do that to your money, would you think somebody else should lend their money to you at that price? This is why I'm not calling this as interest rate increase. Those people who got their properties around those times when the interest rates were in the ultra low 2%, call them very lucky. But the interest rates in the 6s and 7s should not be considered as high or very high. When I bought my first condo back in 2000, I paid 8.25 for a 5-year arm, not a 30-year fixed. So I have seen those rates, and people have seen much worse. I'll probably drop a link below this video to one website, and it's a phenomenal resource, mortgage-x/trends. Go look for that. So the interest rates at around the 5 or 6, I would say, is normalizing. And now let's see how people are going to deal with this. So the first way people will deal with this is they will jump for the arms. They will not try to get a 30-year fixed anymore. I have seen a lot of people wanting to save monthly payments, and so they do their arms, which are adjustable rate mortgages. And as the name indicates, they are fixed for the promised term, say 5, 7, 10 years from the date the loan was issued, and then it changes as the market varies based on certain indexes. So people will jump to arms because arms are typically cheaper by about 0.375 or 0.5%. So if a 30-year fixed is at 5%, they can probably be lucky to get a 4.625 or a 4.5% interest rate. It does make about, for $1 million mortgage, that makes about $600 difference per month, right? The issue is that after the term, the rate starts varying based on the underlying index that the lender ties it to. So the lender is smart. The lender knows that 25, 30 years, this rate is not going to remain this way. And so they give that incentive in the beginning to tie you down. And then when the market rates are going to jump, the lender is going to probably make more money off of you. The second way a lot of people are going to try to adjust is by going to an even more aggressive product, interest-only loans. And refer to my other video, interest-only loans, about 3 weeks back. You will see the link here. So interest-only loans are just like that. They charge interest only, so you don't pay the principal, so that loan does not get repaid. Works phenomenally well for those people who are going to live in a home for 5 to 10 years, the term of the loan, and then they just move out. The benefit of doing an interest-only loan is they get to keep the equity without doing a huge monthly interest payment, right? So that's your interest-only loan. The third option that most people will have is to increase their down payment and reduce their loan size. In order to qualify, they are going to have to do that. The issue with the higher down payment loan, though, is that most people just don't have the money to even make the down payment. Where are they even going to try to do an increased down payment to reduce their loan? So in fact, the right approach in that case is to pay some points to get the interest rate down. So you buy the rate down a little bit if you have that much money. Otherwise, just buy the high interest rate. That is what I'll call it as the normal interest rate. The last option is on the seller's side. One of our Keller Williams agents, Abhinda from San Ramon, shared a very vivid chart. And it shows that mortgage rates were in the 3s in Jan. And for $5,000 of monthly payment, a home buyer could afford $1,153,000 of a property value. The interest rates on 21st April are now 5.11%, and that corresponds to a purchase price of $990,000. So from $1,153,000, now the buyer can only afford $990,000. It's about a $200,000 difference with 2% interest rate jump. Now, what is going to happen? People are not going to qualify. So, with the interest rate going up that rapidly, the home buyer's affordability has sunk dramatically. But the seller's expectation of home price is just that. They think that, oh, my neighbor sold it for $1.3 million, so, and my house is better than theirs, so I should get $1.4 million. They just don't want to consider, or that is what we call as being in refusal, denial, that they don't want to believe that they are going to get a lower price. So we are going to see a lot of seller remorse now. So like, do you go to the gas pump? It was only $3.50 just before the pandemic and even at the beginning of the pandemic. But as soon as the market started opening now, we are seeing $6 and above in California on a lot of places. Do you flinch? Do you stop driving? No. So similarly, we are going to adapt to the normalizing interest rates by normalizing the payment or normalization of the home values. The current home values are bloated. A lot of us will agree, not the sellers. Sellers will agree when the prices start going down. So we are going to see some move and shake in this market. Watch out. See you on my next one.